Our next guest is looking for higher yields in alternative investments. Ann Lester is a co-manager of the JPMorgan Income Builder Fund, which has a 5-star rating from Morningstar. This fund looks for the highest yields while keeping risk below that of a traditional 60-40 portfolio. And Ann joins us now. Welcome.
Thanks for having me.
So the inception date of this fund is May 2007. A lot has certainly changed in the world since May of 2007, but the mandate remains the same, which is looking for higher yields. Tell us about some of the changes that you've had to make since May of 2007.
You know, when we launched the fund, we had kind of a traditional asset allocation, and a lot of the things that have happened since have really made us focus on high yield in particular. Certainly in the huge sell-off that happened in 2008, we saw that high yield we thought was very attractively priced, particularly in December of 08 and January 09. So we allocated a great deal into high yield at that point in time. As the recovery took hold, we started shifting more of the portfolio into higher yielding equities, things like emerging market equities, things like global equities. And most recently, we have been shifting back a little bit out of those equity positions, looking more towards the U.S., a little bit more of a home bias right now, a little maybe away from Europe, and also, yet again, finding high yield more attractive. So we're shifting a little bit back into high yield. So I'd say it's been a high yield story pretty much since 08.
How about the pricing in high yield right now? Because it's certainly not as dislocated as it was back in 2008, 2009.
No, that was a screaming, raving buy. There was a lot more uncertainty in the world then, too, though. If we look at where high yield is trading right now, it's, we think, discounting about a 6% default rate, and default rates have actually been falling. So although it hasn't gotten as cheap as it was, we still think it's very, very cheap based on our outlook on the U.S. economy, which is, broadly speaking, that the economy will be growing and not shrinking.
Now, geographically, your fund is most geared to North America right now, somewhere about 65%, and then emerging markets after that. What areas within the United States offer the best mix of income and also some prospect of capital appreciation? I'm
going to say high yield yet again. So if we look at the markets, right, equity obviously a place for long-term growth, and we really do like U.S. large cap stocks. We like U.S. dividend-oriented value stocks, and that's, again, what we're owning in the U.S. in the equity market. But really, for us, it's high yield. And again, the very compelling lack of leverage on the balance sheets of most high yield companies, the fact that they've been refinancing their outstanding debt before this latest sort of bubble of nervousness means that they've got very clean balance sheets, lots of low debt service payments, and we think lots and lots of room to weather a potential storm, which we're not even forecasting.
So they're done deleveraging?
Yes. Well, yeah, I think so. Yeah, I think so.
Okay. Let's talk about some of the headline-driven markets that force markets to move in concert right now. It's this all-in, all-out mentality with a complete reversal the next day. Today is a perfect example of that. Which recent headlines have caused you to have to change a position?
So we try very, very hard not to change our portfolio positions based on the headline of the day because, as you say, we're getting blown back and forth a great deal. We really think it's a question of headwinds and tailwinds. The tailwinds, we think, are still in place in this economy based on a cyclical recovery coming out of 08. The headwinds are headline risk from Europe, our own political issues not getting resolved quickly, and that battle of which is winning, the headwind or the tailwind, is getting stronger and stronger. So the tailwinds are getting stronger. We're seeing, good economic data. We got some great numbers from the housing market. Germany also giving us good headline numbers. So the tailwinds are there, but at the same time, those headwinds keep coming back. So depending on what's happening, one of the other blows, we're trying to look through all that to see, what's our forecast. And frankly, although we do think Europe is probably in a recession or slipping towards one quickly, the U.S. we think will sidestep that. And because of that, again, we like, broadly speaking, risk assets, but we also want to be a little bit defensive. And that's, again, why we've pulled a little bit out of equities and are tilting a little more towards high yield. So still possibility for growth. We're not hiding, but at the same time, a little less risk than we had before.
Okay, I was looking at some of your holdings in the debt markets, and you're steering clear of U.S. and European sovereign debt, and it looks like you like Brazil, Kazakhstan, Nigeria. These are places with a lot of natural resources.
Yes, exactly. And again, when you look at buying sovereign debt, you really want to look at countries you think can continue to make those debt service payments and have positive balance of payments in those countries. So those are some of the reasons for that.
All right. Thank you so much for your time.
Thank you very much for having me.
Ann Lester, one of the portfolio managers at JPMorgan Asset Management, and she co-manages the $2.1 billion JPMorgan Income Builder Fund.